Give it a go, I think. It's 11 o'clock. There's quite a lot of news this week. Crazy, really. We had some weeks where it's been probably ending and it's been well overrun. I guess people are just trying to get things done before the end of the year. I'm going to hand over to Hattie. I'll go have a look at news stories. He's going to talk about what happened in November. And then I'll be talking to Charles Luke of Marine Trust. News first then. So more mergers. Everything China shows especially to China's stock situations. Troy income growth and STS global income growth. We had some news from Vietnam falling, and then some positive news from just mine infrastructure. Those are the ones I picked out. There's also a story on everything in terms of European logistics. But Richard's going to talk about next week. So let's talk about the Chinese merger first. So, China has not been in existence very long, and the performance has been great, and that's not really its fault. It's China and great either. It's not too big, and I think they thought when they created it that there'd be an opportunity to capture them what was then sort of more enthusiasm around the Chinese story and expand the funds and dilute the shareholder. And the discount did sort of nudge up a bit. So very briefly, you can see the points fell off. And it widened out again, never really narrowed. So the big shoulders through there at the beginning is still there. Fidelity China is obviously a much bigger fund. As I say, it's in the team. In China. And its discounts widened out too, but not to the same extent. So that's a percentage discount. And £1 billion. So
is that one better? Let's just see if that's better on the microphone. Yeah, so it's about £1 billion market cap. And then performance-wise, the Aberdeen China is an awful long way behind Fidelity China in NAV terms over a year. And that's really all you can look at is a year's worth of returns there, because these relate more to the previous Aberdeen emerging markets one. And rationalising the sector probably just makes sense, because although there's a lot of enthusiasm about China a couple of years ago, it's much less so now. We'll see what happens. So it's a very straightforward deal, as per usual. It's the equivalent of a Section 110 scheme, but it's Guernsey fund, so that's why. You can choose to take cash for your Aberdeen China holding, but only up to the value of a third of the fund, and that's at a 2% discount to the formula asset value. So if you go for more than that, they'll be subject to scaling back. So you only get more cash to the extent other people don't opt for cash, because the default option is going to be Fidelity China. Timing wise, it'll all be done as soon as they can get it published and voted on. The proposals would hope to be implemented by the end of the first quarter of 2024, and it should just be a straightforward slam dunk thing, because they've already got almost 3/4 of the shareholders signed up to it. And this, as I say at the beginning, this was the problem, that this share issue is just way too concentrated. And I think that some of these hope they'll be able to sell their shares down at a relatively narrow discount as the China story evolved, and then couldn't get out. Obviously, though, we're just importing this problem into Fidelity China. The fact that it's a much bigger, more liquid fund, that should help. But you do to run the risk that there might be sort of a slight overhang here. Nevertheless, I've decided in all of this that I'm going to consolidate my Chinese holdings into Fidelity China via this route. Troy and STS Global, obviously run by the same manager. They have this zero discount-ish policy. So it trades very close to asset value. STS obviously was Securities Trust of Scotland. This is this chart here. And you see that discount policy has worked fairly well, although it's been a discount recently. So that means it's been buying back stock. and the market cap's now about 200 million, which is a bit on the small side, especially in this global equity income sector. Troy, same sort of thing, trades around asset value, not far away from anyway, but this is all shrinkage all the way through here. And then it said basically we're going to suspend the buyback now. They were running out of room anyway to keep it going, but also I think they felt, well, we're inside on this idea of knocking two funds together, so we can't really carry on going. So the discount spiked out. That will obviously snap back in again if the merger goes through. So same thing, such as 110 thing, done from an asset value basis. This time the cash exit option is 100%. So you can get out all of your holding in Troy if you want to, at a 2% discount to full asset value. But the default option is a rollover. I think they think, and I think they're probably right, that quite a lot of the shareholder base is actually going to roll into STS because there's a sort of continuity here. Cost-wise, we didn't know what the situation was on the Chinese one. We're going to have to wait and find out when they publish the circular. But on this one, there is a cost contribution from the manager, and it basically works by waiving its fee. And we had this a couple of weeks ago with another fund. So the cost benefit goes to the acquiring fund first, and then once its costs are covered, then the fund being acquired's costs are covered. The fee on the bigger fund is going to get cut anyway, so the ongoing charges ratio for both is going to end up lower than it was, which is all good news. And there's no real change in the approach to investing in STS. If you want to know how all that works, we interviewed the manager on 11th of March, and that hasn't changed at all. So go back and have a look at that one. The interesting thing about it is that although STS is a global fund, it's got about a third of the fund in UK equities, and that just is sort of like done on a value basis. So there is quite a lot of overlap. I think there's about 15 holdings in common, and anyway, they're relatively liquid holdings, so it should be quite easy to knock the two together. The only sort of niggle in all of this, I kept moaning that the Troy fund didn't yield enough anyway. And you see it's a long way south of the all-share yield, and I think it can contribute a premium to it. Obviously, that's now going away, and the FTSE income growth is the one to moan about. But when you do this, you do end up with a small cut in the dividend for Troy shareholders. It's going to be so small as to be barely noticeable, and maybe STS will bump its dividend up in the way enough to cover it. But obviously, you go into global equities, apart from the UK, there are very few markets that offer decent yields, and so the yield on the world index is a lot lower than it is on the all share, and that's the reason why you're going to lower income. Now, Vietnam Holding, this is a fund we like. This is a fund we write on quite regularly. The only problem with this fund, really the only problem with this fund, is that it's too small, 85 million market cap, and the discount has been narrowing recently on the back of good performance. You can see the ramping up in absolute terms there. Vietnam's had a bit of sort of a shakeout on the back of property problems, but that's working its way through too, and the thing's recovering. We talked to Craig Martin, the manager, only 3 weeks ago. So again, you can go back and watch that if you want to know a bit more about it. But there's an AGM on 21st of December, and that's going to include a continuation vote. I cannot believe that they're going to lose this on the back of the good performance that they've got. But nevertheless, the board has decided that it wants to introduce an annual redemption facility. So the first redemption opportunity is going to be 30th September 2024, provided that shareholders approve it on 21st of December. Quite cleverly, it'll only really work if you're a long-term shareholder. So you won't get to participate at all if you haven't held the shares for 6 months. And then there are sort of discount penalties that apply depending on how long you've held the shares for. So you can get out asset value, but only if you've held the shares for 2 years before the redemption point. So effectively, you would have had to be holding them since September last year. I think that's all a good move. The way that they calculate the exit price will be put all the assets into a redemption pool and then sell them off. Obviously, some holdings in Vietnam Holding are more liquid than others, but I wouldn't have thought that would have been a particularly long process. And as I say, the reason why it shouldn't really be necessary, A, this thing trades at a relatively tight discount in the first place, and B, its performance is just so much better than the rest of them that it ought to be getting the credit for that. But nevertheless, there is a real risk here that the fund could disappear. So if too many people opt for the redemption pool, the directors have got a kind of minimum viable fund size in mind. They could just say, well, this is tough, we'll knock it on the head, or we'll merge it with one of the other ones perhaps. But, and this is why I think the board have done it, I don't think one-off redemptions, even annually, are enough to keep a discount narrow all year. But around the time of the redemption, the thing should trade in towards asset value. And I think, providing the performance is still strong, they'll be using that opportunity to try and place stock with new investors. And it may be possible to do that. We'll just kind of have to wait and see. It depends really on how good the broker is. Because the story's great, and I think it deserves to expand rather than disappear. Now, the bad news story, Digital 9. Share price has hit a new low. It really is pretty dreadful. If you remember, I was getting all excited about it, and I bought stock sort of around here-ish, and now I'm not looking too clever. The reason that I thought it was attractive was because they were sorting out their cash flow problems by selling Verne Global Group, and they are going ahead with that, but it's all about the price they're getting. So the total price that they could end up with is 456 million, no more than that. But only 349 of that comes in cash up front, and even then, some of that is delayed a little. The rest of it is based on earnouts. Now, I'm not sure how challenging that earnout is, but it wouldn't take an awful lot. So basically, you'd lose the whole thing if the EBITDA for the year ending December 2026 is not 80% of the target. So it could be that they've sold their best asset for 350 million quid. We'll really hope that isn't the case. But I think that's what people are slightly panicking about. That and the fact that obviously if you've got an earnout that's based on a measure that applies to that year, you're not going to get that money until some point in 2027. So there's quite a long wait for that. There's also a clause in there that says that if something goes wrong from a earthquake or volcano or whatever in Iceland, then the deal might be pulled. That's not that fanciful really. Their data center plant is here just outside the airport in Keflavik, and obviously here is where we're thinking the eruption might be, and here is where the power plant is. I don't know that if that power plant's knocked out that that'll be affected or not, or if that would be enough to have force majeure if actually keep the deal into touch. We'll just have to wait and see. But there is a sort of a real risk there that we think about. Anyway, so assuming it all happens, they're going to use the first few 100 million to pay down the revolving credit facility. Although there's a little clause in there, and I'm not sure what that means, but they might have to hold some of that back to get that done. And there's also another line in there that doesn't really make not completely clear what it means, is that they're going to have to fund Verne through to the closing of the transaction. So we don't know how much money that is, and also it's not clear to me whether you get that back again. So if Verne says it needs another 25 million and you don't put that in, does that just get repaid, or is it included in the transaction price? I think it would be repaid, but it'd be nice if they clarified that. So all in all, not great. There's an immediate hit to NAV, which I think is about 2.8p, assuming that you're going to get the 456. If you don't get the earnout money, that's 15p off the NAV. But given what the share price has done, it's still on a massive discount. So that's a discount of between 67.7 and 63.1. They have kicked off a strategic review. They are going to review the management arrangements. They are going to tweak the board. fingers crossed all of that turns out to some kind of orderly realization portfolio or a sale of the fund to somebody else, and that just then gets shut down and it looks like a decent investment again. But at the moment, I can understand why people are a bit upset. Right, that's enough for me. Let's talk to Andrew.
Well, there's a great deal going on, isn't there, James? My goodness, and a lot of moving parts there on the Digital 9 news as well. Yes, it has been a very, very busy time for the sector, and actually a good month for a change. So in November, actually the market did move considerably higher after 3 months of declines. And this was obviously very welcome. The investment trust index, I think, was up about 6.8% over the month. And there were some very substantial rises, as you can see. Now, I think actually, of course, we spend a lot of time on the minutiae of the investment trust industry, and we're a little bit obsessed by all of these deals occurring. But actually, the overriding influence, it seemed to me last month, was nothing to do with any of that, and it was interest rates and interest rate expectations. There's this very big macro overlay at the present time, I think, which is driving these share prices. And I think that's evident from this list, where pretty much everything on the list is either growth capital, renewable energy, or real estate. And those are the three most interest rate sensitive sectors. So anyway, some very impressive, substantial rises. Nice to have some recovery in some of those share prices, generally from lower bases. These are the ones I'll talk about today. A couple of the battery storage trusts near the top of the list, plus Aberdeen European Logistics. So that was all right that you didn't talk about that today, James. And Target Healthcare REIT. So first of all, the battery storage trust, you can see from this chart, I mean, they've been very depressed, and it seemed to me that they were hammered more than most actually in the renewable energy sell-off, partly because of the future concerns about UK power prices and the fact that they were not being rewarded as much as they perhaps expected. But the sell-off, I think, looked pretty overdone, and the discounts became extremely wide, approaching 40%, before this significant bounce. Nevertheless, I think the value is still there. And if you look at these current discounts on the slide there, between 26 and 30%, and the high yields as well, I don't think we can say in any shape or form that this recovery in prices has gone all the way. So we'll have to see. On the chart there, it's Gore Street in the black, Gresham House in the blue, and Harmony Energy in the green. You can see Harmony's been a little less volatile than the other two, and it's a bit different because it has more development assets. And I think that leads me on to the reasons for optimism actually in this sector. And I think there are quite a few, including the fact that National Grid has obviously been told that this issue with the delay in getting a grid connection is really unacceptable and causing difficulty for the greening of the UK economy. And so it's being encouraged now to accelerate the availability of grid connections, and it's working on that. I was also reading, and I don't have a full understanding of this, but apparently it's going to start a new dispatch algorithm next month, which is the way the grid determines exactly how much battery energy storage it's using and how much impact that can have on these trusts that are providing these services. So we'll have to see if that makes a difference. That could be positive. But my view is that with these very wide discounts, actually, there's still quite a lot of scope for growth here. And in particular, as more projects come online, I think we'll see the NAVs quite well supported. So this broad decline across the sector, which I think really has pulled down all of the prices quite indiscriminately, I think does provide opportunities for patient investors. But you'd have to have a positive view, I think, on interest rates, because that is such an important factor. Onto something more specific now. This was another riser over the month. Aberdeen European Logistics Income, which was trading on a very wide discount of around 40% before this news. Effectively, what's happened here is that the trust had a continuation vote penciled in, well, actually not penned in, actually, for next June. But effectively, the board has decided to bring the activity forward now by instigating a strategic review, effectively putting itself up for sale, or in the shop window anyway, let's say. And the board says that in addition to that very wide discount, is perhaps too small, with about 400 million euro of assets, and it's paying an uncovered dividend as well. So there are some issues it needs to work through. So I think what it's doing now is it's really saying to any potential suitors, look, if you want to buy our assets, come and have a chat. And that is a strategy that you might remember was employed by Aberdeen Diversified Income and Growth, and actually didn't work for that trust because no one came through with a suitable offer. There's not necessarily any read across, but I think, especially given the bump in the share price that has occurred this week, it's reasonable to be slightly skeptical. And actually, if no deal is struck as a result of this review, then I think the trust will probably propose some kind of softer proposals to give some money back to shareholders, but also to reduce that dividend. So we'll have to see what happens. That'll take some time now for the board to work through. And on that point, actually, I mean, I think this avalanche of news that we're getting at the present time is the result, of course, of a few months of work that have been occurring, and it relates back to us talking about these wide discounts through the summer, really. And of course, we're hoping for an instant response, but it takes a bit of time for the boards to have their discussions, to engage their advisors and to come up with these plans. So this news that we're seeing now is really relating to the wide discounts we've been seeing for a few months. And for that reason, I don't think this is a one-off. I think James and his colleagues are going to be quite busy for quite some time to come, actually. One thing that I've been thinking about and writing about in my newsletter is that it's all very well, of course, having all of these great buying opportunities on these wide discounts, but you've got to find the cash from somewhere. And that's the difficulty, that if everything is on a wide discount in your portfolio, how do you find something to sell? And so my thinking is that actually you don't have to have a full recovery in share prices. You don't have to get back to par or back to a premium in order to think, well, maybe it's time to switch out. Actually, a partial recovery can be enough. So I've been looking for trusts on that basis that maybe one could release a little bit of money from. One I've been thinking about was Target Healthcare REIT, which is up about 20% this month. It's close to its best levels in the last year, and the discount has come in quite a bit. The yields come down, and those figures are still not bad. But actually, if you compare those figures to some others across the sector, I think there's a case to be made for taking a little bit of cash out of this one and recycling it. I mean, just as many trust managers are recycling their capital, I think as investors, we can also profit from doing the same thing. In this case, Impact Healthcare REIT's a fairly direct competitor. Looks a bit better on those simple metrics of discount and yield, although, of course, you have to take into account qualitative factors as well. But I think it's an interesting consideration at the present time, how you can release some cash from your portfolio to recycle it. And I'll come back to one more in a moment. So the falls now are much less dramatic. There were a few, of course, and I thought James would probably cover Digital 9 infrastructure at the top there. It's an interesting one. I suspect that will be on one of the lists of movers next month as well. We'll have to see. Some of the old names on there that we've been seeing on the list for a while, like Hypnosis Songs Fund, still working its way through its issues. Phoenix Spree Deutschland still struggling with the German real estate. But I think there's a couple of interesting things here. US Solar Fund, I'll mention, and Tetragon Financial Group. So US Solar Fund, first of all, which went down this month, this trust does have a checkered history, and it hasn't been successful at all, actually, for investors. And it did have a strategic review back in, it straddled 2022 and 23, where effectively the managers withdrew and the trust wanted to find a buyer. It didn't find a satisfactory buyer for its assets. And so instead it's appointed new managers in the form of Amber Infrastructure, who actually start the job today. So it's very, very relevant. And you can see from the chart here that this trust is pretty friendless, actually. The shares have been falling for pretty much all of the year. They're very near the bottom and haven't shown any hint of recovery whatsoever. I wonder now whether Amber starting work could potentially mark an inflection point. And certainly in terms of the valuation here, it does look as though there's considerable scope for recovery if things do improve, and it's going to require a bit of work. But the discount is 40%, the yield is 11%. And that's interesting because often we're seeing these headline yields, but the dividends are uncovered and maybe therefore a little bit false. So it was worth having a little look at a bit more detail here. And it so happened actually that the trust released its quarterly NAV yesterday, which was up slightly over the quarter, which was quite encouraging. Its dividend is in line with its target. And the third point here is that dividend cover is greater than 1. So it's actually 1.25 for the 12 months to the end of September. And for the full year here, they're saying it's going to be 1.09. So that's a fully covered dividend yield of 11%. And there's quite a lot going on here. One of the changes that the trust made, in addition to the manager, was that it said that its projects didn't have to be tied into the very long-term power price agreements that it had previously. And they have a bit more flexibility now. And 6 of them have just signed new renewable energy contracts, which are going to be reflected in the next quarterly NAV. And I had a look at some research actually on what's been happening to the energy prices that are being paid to solar companies in the US. And the PPA prices have been rising actually quite substantially since 2020. And they've just come off their peak, but actually they're still higher than they have been in the past. So I think that's actually quite helpful that they have this additional flexibility. They can also put some money into development projects, which might help the future NAV. So I think the picture's perfectly stable and reasonable here. We're probably not going to hear anything substantial from the new managers for a while, I suspect, as they bed in and start to work their way through the portfolio and see what they can achieve. So it may not be until March, actually, you get the next update. On that basis, I don't think there's necessarily any immediate case for you to rush out as soon as we stop talking here and go and buy the shares. But it's certainly one I'm going to follow closely. And I think if we're thinking about a broad recovery, a revival in the renewable energy sector, then I would expect this trust to play its part. Finally now, Tetragon Financial Group. This is a real oddity in the sector, always on a massive discount, partly because you don't have any voting rights. It's just coming up to its periodic tender offer, which it has, I think, once a year, but certainly every so often. This is conducted on a reverse Dutch auction basis, and you might not know what that is, but what it means is you basically specify the price at which you're prepared to sell your shares there's a range available. And then once all of the demand is met, that is the same price paid to everybody. The point of mentioning this is that the shares are trading at $9.70-ish. You can sell them for $9.60 in the market, but you could tender them if you wish at $10.50. And there's no guarantee, of course, you get to come out at that price, but you might. And if we're talking about ways to release capital from your portfolio, this is maybe one thing to think of. It's not really a discount switching policy because, of course, this trust itself is on a massive discount. But I'm always looking for ways I can get a small uplift from my existing carrying value. And this is one way potentially to do it. All right. On that, I think I'm finished, James. So I'll hand back to you.
Thank you, Andrew. Good stuff as always. Yeah, and good job. We didn't do Ashley. Yeah, cool.